Next, I'd like to invite Elizabeth Frazier. Elizabeth is going to come up and bring us up to speed on everything that we have going on in Augusta. MEREDA's mission is to promote an environment for responsible development and ownership in Maine. Our advocacy work provides our members great value. We've created a strong voice in Augusta, driven by a very active public policy committee. Many of you are here today, and thank you so much for your hard work. It's making a huge difference. A big thanks to Paul Peck of Drummond & Drummond, Jason Howe of Pretty Flaherty, who both co-chair the Public Policy Committee. And a thank you to our Legislative Council team led by Elizabeth Frazier here from Pierce Atwood. They've consistently helped MEREDA pass legislation that improves the real estate climate in Maine. And here's Beth to tell us more about that. Thank you so much.
Good morning, everyone. It's great to be with you today. Some of you have seen me already this morning, and you might hear it in my voice a little bit. I have been sick. I promise that if you see me, this is the 8th day of this horrible thing that some people are referring to as the plague, and I'm sure many of you know people who have it, so I'm not contagious. But I do apologize for my croaky voice. So, welcome. It's great to be with you all again to talk about what is going on in Augusta and MEREDA's legislative advocacy. There's a lot, as you can imagine. This is probably the biggest year or 2 years coming up that we've ever seen for housing in Maine. And that's pretty considerable when you think about all that was done in the last couple of years in housing in Maine. So this is a little bit of a joke, but not really. My forecast for the next couple of years with respect to advocacy in Augusta is pretty much housing, housing, and housing. So I want to break that down for you and talk about the big picture in housing, how MEREDA views it, what MEREDA is doing, how it is affecting change in that space to make it easier to create housing, and then a little bit of the sort of future of how housing is here to stay and what that means for Maine. And I'll just say that as a little bit of a preview to that, I could not agree more with Chris's statements about being all in on Maine for the coming years. I think we see a lot of opportunity for business growth, for folks to move here who have never been here before, and for our young people to stay. But, and this is like the biggest but on earth, only if we build the housing. Some of you may have heard recently there was an article in Vermont that referenced the fact that they had this, tremendous infill of people from COVID, and almost all of them left because they couldn't find affordable housing. And Vermont is in a very similar position to Maine. So it is a crisis. It's one that certainly MEREDA is all in on. I think our state legislators are all in on, but it's one that we've got to make a lot of progress on. So what is the big picture of housing in Maine? Oh. Wasn't just Chris. Okay. So the big picture of housing in Maine is that we need, there's the typo in my thing. Sorry about that. It's 86,000 new units, not 76,000 new units. We need 86,000 new units of housing in Maine, essentially by 2030. And that covers what we think we'll need in terms of people who are going to move here, but also our historic underproduction, which, as many of you know, is fairly significant and contributes to the current lack of housing that we have today and those high costs in the marketplace. So I'm going to go through these early slides fairly quickly because I don't want to take too much time on them, and there's a lot of content in here today. So 86,000 new units. How do we know that, and how are we going to build them? Well, we know it because the state of Maine, legislature, Maine Housing, and the Governor's Office of Policy, Innovation, and the Future, known as GOPIF, have initiated some studies. And the first one, the State of Maine Housing Production Needs Study, told us that we needed 86,000 new units. And it broke that down into sort of different categories of historic underproduction, where we think the need is going to come, and how fast we need to build it. The second one, and arguably sort of more important, is the statewide and regional housing production goals, because that showed us where the housing needs to be built. And it's not just Cumberland County. I mean, we absolutely need housing in Cumberland County, but if you look around the state, it has to be built everywhere. Island communities are struggling with affordable and attainable housing. Rural communities are struggling with it. These are things that this report really spoke well to and talks about the specific needs in those various counties and communities. And then finally, and this is the one I'm going to talk about for a couple of minutes here, is the roadmap for the future of housing production in Maine. And this just came out a few weeks ago. Some of you may have heard of it. This was produced by the same company that has done work on the other two reports, HR&A. They're an advisor group. The gentleman who did the reporting came to Augusta a few weeks ago, and I wish I could have clipped the presentation he gave to the committee, but I wasn't able to. Suffice it to say, his parting words to the Housing and Economic Development Committee were something along the lines of, if you leave housing up to localities, it will not be built. And it was a very blunt statement, and I think one that legislators are taking to heart. And I'm going to talk a little bit more about that and some other things that he said in that report. So I don't want to go into too much detail on this report. It's all out there and available for you to find online. You can just Google HR&A roadmap for housing in Maine, you'll find it. But there are three parts of the report that sort of make up the main recommendations, and I thought I would cover them briefly to give you all a sense of where the research foundation now lies in terms of advocacy, what we can build on, and also what has been clearly identified as problematic. So the first one here, streamlining processes and building capacity. What they refer to in this is really streamlining government processes and building government capacity. And that means increasing, the pace in which applications and projects are reviewed, trying to reduce repetition in review, et cetera. I've sort of broken it down here to show you where some of their recommendations fall. So DEP, for example, I've only said DEP. There's a lot of specific recommendations about that. They include things that DEP is already doing, like looking into third-party review for project applications. That's something that is coming online. Some of you are probably already aware of it. In addition to that, building code. There are barriers in the building code that already exist. There's a new building code coming online in a few weeks that will also likely create some new barriers and potentially increase costs. Impact fees, we all know about those. Those are something that the Maine State Chamber is starting to take a look at, as well as MEREDA. And then obviously municipalities, that sort of goes along with DEP and approvals. It's that same needing to speed up the pace at which projects are reviewed. So I would encourage you all to take a look at that section of the report if you're interested in that sort of those provisions. But the report also went on to talk about the need for transparency in government processes. And this doesn't just include things like transparent fees, which are very important and something that we're going to continue to focus on, but also providing information to people that you actually want to come into your community and build the housing so that they can do it. So tracking, for example, projects that have been submitted, applications that have been submitted, things that don't go forward, things that do go forward, what housing is being built in your community. Trying to encourage communities to actually track this stuff and then to be more transparent with their residents about the housing that is and is not being built and how that affects their communities. And then lastly, and this is particularly relevant to all of us, strengthen the private sector. And in this case, they talk about a few things. I think, universally the notion is that with all the housing construction that's going to come, hopefully, we will need to increase capacity amongst sort of all of you here in Maine to make that happen. And they did talk about things like developers of scale. There aren't very many in Maine right now. That's something that, they recognize as a potential issue. But they also saw opportunities in using technology like 3D printing and mass timber. We heard a little bit about that before, and these are ways that the report sort of sees as taking what Maine has, leveraging what Maine has, and using creative solutions to come up with housing that we desperately need. So that's the report. What it does is set the groundwork for all the work that I'm about to talk about next, which is coming in front of the legislature even as we speak. And that work is guided by the Public Policy Committee. Many of you, some of you have been to meetings before. If you haven't, I certainly encourage you to do so. It's very exciting. We go through all the bills that are currently being discussed in Augusta, and we take some time to talk about them and figure out how we want to engage on them. We also develop our own proactive policy agenda, which I'm going to talk about in a minute. And Jason Howe and Paul Peck, whom Shannon mentioned earlier, are fearless leaders in this regard, and we could not do the work without them. So I know they're here, and I appreciate their work. So I want to talk about what we're going to do because there's a lot of exciting stuff that we're going to do. But I would be remiss not to talk about the things that we have done. In the last 2 years, MEREDA actually successfully passed 3 pieces of legislation, which is a lot. And they are directly aimed at trying to lower barriers that we know exist. MEREDA and the Public Policy Committee have been very committed to looking at effective solutions to housing, taking on the things that our members come to us and say, hey, we have a problem with this, looking at how we can fix it. So how did we do that? Well, here's an example. We knew of a project down in Kittery that was basically killed because of a retroactive application of an ordinance that would have provided 900 units of housing. So we thought, gee, that doesn't sound right. So we wrote up LD 772, and we got it passed, and it was signed into law by the governor, and it is now effective. Now, when you submit your application to a town legislative authority like a planning board, so long as your application is complete, that application is set, and you will play by the rules of which have already been written, not rules that might come down the line someday later. This was very exciting. This cleaned up 20 plus years of confusion and silliness, frankly, in Maine law that was really never intended by the legislature. And so it's really exciting for everyone in this room to be able to take a little bit more measure of confidence in what they're doing, a little bit more guarantee when they go out to do a big project, that they're not going to be completely blindsided and stuck holding the bag at the last minute. So this is a very exciting piece of work, and I appreciate all the help MEREDA members gave to making it happen. We also modernized the Condo Act. This one might not seem very exciting, but it's actually very helpful to things like affordable housing projects. So if you have a big mill that you're rehabbing, you don't always necessarily want one developer developing the whole mill because it's not their forte. But you might have someone go in and rehab it to a basic level, and then they might like to condo it out and give it to other developers who will finish it for that end product. Like you might have a mix of affordable housing and restaurants and co-working space in a mill. This bill allowed that to happen so that the transfer could occur. Previously, the transfer was disallowed because the project was actually unfinished. Now it is easily allowed, and that was very exciting. And then lastly, and this is probably the best example in addition to the retroactive ordinances of practical problems that we felt we needed to solve, Maine had a little bit of a snafu in the elevator laws, whereby basically all buildings were going to have to be square because all elevators had to go to all floors, and it didn't make a whole lot of sense. So MEREDA set out to adjust that and to bring the statute up to date with the current International Building Code, which says that at least one elevator must arrive at least every floor. And so that will continue to update with the building codes whenever the codes are updated. So it will now stay modernized and updated, which will be very helpful. And as part of that work, we actually uncovered a little bit more in the world of elevators, which is that it's a challenge. It has been a challenge historically to get inspectors on site. It's a timing issue. And so we worked with the department to try to make a change there, and were successful. They made some rule changes to better support themselves financially. Some of you will see changes to the fee structure relating to elevator inspections, but that is also to allow for easier scheduling and increased hiring of inspectors. So these are things that, while not necessarily sexy, really make a huge difference in the day-to-day life of all of you. So those are some of the things we've done. How about the things we're going to do? Well, we talked about the HRNA report, and I think that provides the roadmap in a lot of ways for what we are seeing at the legislature in the next 2 years. MEREDA has taken 3 issues that we are sort of spearheading, but we are also working with a number of allies and partner groups to move other issues as well, and I will try to touch on them, but I probably won't hit all of them. So if you have questions, please find me after. So what are we working on? The historic tax credit. So if you've been here before, you know that this comes around every few years. There is a sunset date in the historic tax credit law that currently will cause the law to expire in 2030, and that's the state level historic tax credit, not the federal. So we're working to eliminate the sunset, or at a minimum to move it out further to allow projects to continue to move through that pipeline, which is very important. We're also working with our friends at Maine Preservation to expand the program to include non-income producing properties, which would be homeowners. So allow for homeowner rehabilitation of projects, and also to correct or fix the small project set aside that currently exists in the statute, which isn't very effective. The cutoff is, I think, like $250,000 or something, very, very low. No one would ever use it. So we are raising that threshold in a way that would hopefully make the credit more effective for more small projects. We are also working on, oops, sorry. I just realized I'm getting ahead of myself. Okay. We're also working on, this is a very exciting proposition. This is the density bonus bill. It sort of builds on the work of LD 2003, which many of you are probably familiar with, that allowed for a certain number of residential projects to be built where traditional single-family homes are allowed. This builds on that by allowing for a density bonus depending on what kind of affordable housing you're building and how much of it you're building. So, for example, in my little chart here, the green is the income level. I realize I forgot to actually indicate what that was. So the light green bar on the left would be if you're building to, say, I'll pick in the middle, greater than 120% of AMI, but less than 180% of AMI. Your density bonus is 45%. And I should say these numbers are slightly squishy. There's still time in the legislature to make some changes. These may not be exactly where we wind up in terms of percentages, but this will give you an idea of where we're going. This is intended to allow for what is often referred to as actual inclusionary zoning. Not the bad inclusionary zoning that we're all stuck with in Portland, but inclusionary zoning that actually allows for builders to build to workforce housing so that they can build right alongside their market rate housing. And this is really exciting opportunity that we are getting underway in Augusta right now. I did want to mention too, there's an alternative to the density bonus. If you happen to be in a rural area where they have crazy acreage requirements, like 100 acres per lot or something, this would provide an alternative minimum lot size. So you could take a reduction in the minimum lot size instead of your density bonus if you determined that was more effective for you and your project. And all of this is intended to help deal with the problem of projects not penciling. Workforce housing projects, which is anything from 80% to 220% of AMI, and where most Mainers live, are basically impossible to build right now. And so without money to throw at the problem, because the state is not particularly flush at the moment, this is something that we can do, and it's something that you're going to hear a lot more about in the next couple of months. So stay tuned as we get this off the ground and start asking for all of you to pitch in and help us get it passed. Yes, okay. In addition, we are also taking on a subdivision issue. So there are a couple of subdivision bills up in the legislature right now, one that we're going to be very supportive of. There's actually a public hearing on it today. That is to study subdivision writ large. And by subdivision, I am referring to the state statutes that require municipalities to do subdivision review according to certain criteria. I'm not referring to SLOTA. I am going to talk about SLOTA in a second, though. We are looking at, as a way of sort of correcting an issue that occurred in LD 2003, raising the threshold from 3 dwelling units or lots to 5 dwelling units or lots before subdivision would kick in. So how is this helpful? Well, LD 2003 allows essentially 4 units on a lot. You could also do a mix of things, right? You could do 3. You could have your own. You could build a residential unit, and then you could do an ADU. Well, that's great, except if you want to do those things within a 5-year period, now you're in subdivision review. And that's probably not something that's very conducive to the sort of small-scale infill development that LD 2003 was really intended to unlock. So if we are successful, this bill would really raise that threshold and allow a lot more of those smaller infill projects to move forward without going through the repetitive subdivision review at the municipal level. Of course, you would still have site plan review and other requirements in those towns. But this is very exciting. I wanted to say, I said it's not SLOTA. This is not. However, this dovetails very nicely with something the Department of Environmental Protection has proposed, which is the exact same threshold increase. Actually, I might be wrong. It might be to 4. I think they're proposing a threshold to 4 for SLOTA subdivision. So if you're in a much bigger project and you happen to trigger SLOTA subdivision, that is going to be a slightly different threshold now as well, which is very good. So MEREDA thinking along the same lines as the DEP, saying, hey, we know there's going to be a lot of volume. We want to concentrate our review on those projects that are going to be really significant and have more likelihood of an environmental impact. And so that is what we are trying to do here. I talked about the tax credit already, but here it is again, just in case you all wanted to see it. I had some lovely pictures here. If you're not quite sure what these are, I think I aligned them, but I won't swear to it. So I think the one in the upper right-hand corner is, in fact, a mill from Biddeford, and down in the lower left-hand corner, that's the Lincoln Hotel I think it's in Biddeford, but if it's in Saco, somebody help me. Okay, it's Biddeford. And just a great example. There are great examples all over the state, incredible examples of the historic tax credit, but this is just one of them, and I wanted to just call it out. So what does that mean? Well, housing is here to stay. What you see here are actually the titles of all bills related to housing in the legislature this year. 157 bills have been assigned to the Housing and Economic Development Committee. Not all of those are housing bills, but I'm guessing 90% of them are housing bills. That doesn't account for any bills that relate to landlord-tenant law that go to judiciary, and a number of other bills that may go to other committees as well. So there is a significant number of bills related to housing. And MEREDA is really proud to be working with a number of stakeholders. I'll name them, but I won't get them all. We've got the Portland Regional Chamber of Commerce, who's right in the room right now. They do tremendous work in this space. We work with Maine Preservation. We work with GrowSmart. We work with the environmental groups and organizations. And we try to, with GoPIF, the governor's office, of course, and our local and regional councils of governments, to try to find the things that are really going to be the most effective for MEREDA members and to make a policy change. It is not always easy to get that done, and sometimes things that feel like low-hanging fruit are actually really big, juicy fruit, and when we get them, we get very excited about it. So a lot of that is due to all of you and the help that you have provided. There's so much to come in the next 3 to 4 months. This legislature will adjourn sometime in late June, maybe. And so we've got time between now and then. They're really starting to ramp up now. You'll start to see action alerts. We do have a new action alert template this year, so hopefully it's more convenient for all of you. I'm going to give it a quick shout out. When you get the action alert, there's a button you can click on that will take you to a page where there is template testimony. You can then just grab pieces you want, put it in a Word document, and then there are also instructions on how to submit that testimony online. So it only takes a couple of minutes. It does make a very big difference. So when you see those action alerts, please click on them and forward them to your friends as well and ask them to do the same, because what you all bring to Augusta, the voices you bring, are dramatically and far away greater than the voice that I can bring by myself. So let me just go here. There, that's what I thought. Okay. So I wanted to just say again, thank you. And thank you to all of our partners who are doing really tremendous work in this space. There is a lot to come. There will probably be a lot of bills carried over into the second session of this legislature. So don't expect that everything will get done now. There will be studies that happen in the interim, so keep your ears and eyes open for those, because those are areas where, again, you can be very influential in participation. And MEREDA will keep you up to date on all of that. But in the meantime, we will continue to work hard in Augusta for all of you, and I really can't thank you enough for the knowledge that you bring to every conversation that I have with all of you. Please keep it coming. I'm a sponge. I love to learn. I want to keep learning, and I could not do it without you, and neither could Pierre Satwood. So thank you so much. It's our honor to represent MEREDA, and we look forward to continuing to do so. Have a great Forecast Conference.
All right. We're on track. Thanks, Beth, so much. That was really informative. I love the work you're doing. Where's everybody going? What's going on out there? All right. I'd like to introduce our next speaker. Ron Dovich is the Senior Relationship Manager at TD Bank. And TD Bank is our gold sponsor. I mentioned this before. It's a stalwart supporter of MEREDA. They're a big reason why MEREDA has been successful for 40 years, and we're immensely grateful for this partnership. Ron, please come on up. Thank you.
All right, thank you, Shannon. Partnership is important to us at TD, and I always love coming to the Forecast Conference. There's great insights, terrific networking opportunity, and important discussions. As we think about the future of Maine's real estate economy, it is essential for us to hear from what an expert thinks about topics such as what impact will tariffs have and will interest rates go down. So let's hear from an expert. James Marple, Senior Economist at TD Bank. James, welcome.
Thank you very much. It's great to be back. I got in yesterday afternoon, was able to have a lobster roll for dinner, so I was very happy to be back in Portland. It is a difficult time to be an economic forecaster, to say the least. We are dealing with a policy environment that is extremely uncertain. We have to try to make assumptions about what may happen. So I will present our baseline economic outlook. I'll try to explain what assumptions we have made in that and talk to some of the risks around it. But it's not just the economy where there are a lot of uncertainties, but obviously also inflation and therefore interest rates, which of course is highly important to the real estate industry. So first, just kind of high level globally, the American economic outperformance that characterized really the last several years has continued through the end of last year into 2024. For the past 2 years, the U.S. economy has grown by nearly 3% year on year on an annual average basis. That is really, for the advanced economy, the fastest growing economy that is out there. Some of America's trading partners, like Canada, have really struggled over the last few years. Interest rates rising quickly was an impediment, especially to the Canadian economy, where households have high levels of debt, and the mortgage rate responds much faster to increases in interest rates, and that has really weighed on growth. In Europe, obviously struggling with both high energy prices in the aftermath of the Ukraine war, also had increases in interest rates. The German economy in particular has really struggled, and we expect some of that to continue over the next year. The Chinese economy, they have a growth target of 5%. They have also seen real issues in achieving that as they also try to rebalance their economy, which has been really its development focused in real estate and also increased levels of debt, especially among local governments. So, I mentioned the policy uncertainty. Our growth outlook, I'll talk to this first. I'll speak to some of the issues here, but I would say some of this uncertainty is obviously around tariffs, and that will impact the American economy, but also very much its trading partners. Okay, so first, the good news. The economy has really outperformed expectations over the last year. I think if I was here last year, our growth expectations was for growth perhaps north of 2%, and in reality, it has come in much closer to 3%. If you look at sort of the sources of economic growth, we tend to look at it in terms of demand and spending among the domestic economy, that is consumers, households, and businesses, and that has been very, very buoyant over the past year, growing by over 3% on a quarterly average rate. We showed the trend here, trend growth, we think, given demographics, given productivity, probably around 2%, and growth has exceeded that pretty consistently over the course of last year. We just had the second estimate for Q4 real GDP growth in the U.S. Grew by 2.3%, which is what we show there, but again, very strong, led by very strong demand. Consumer spending was up over 4% quarter on quarter at an annualized rate. There was more of a drag from inventories as businesses potentially, perhaps a little bit early, but get ahead of some of the tariff risks. So, the president campaigned on two things that came out in the campaign. One was tariffs, and the other was cracking down on illegal immigration. Those things will have an impact on the economy. The president in his first 80 days has signed more executive orders than any president prior to him, even more than the record was Harry Truman with 57. He signed 75 in the first 80 days, which is Truman's record. That was 100 days. So obviously hitting the ground running. The tariffs on February 1st, there was an executive order that would put 25% tariffs on Canada and Mexico, citing a national emergency around drugs coming into the country as well as illegal immigration. That was put on hold until next week, March 4th. And that is, that should say 25% tariff on Mexico and Canada with retaliation. So this is where it gets tricky, right? Trying to determine what the tariff rates will be, how long they will be in effect, and what exemptions there may be for various industries is frankly just impossible. But we're doing our best. If we see sort of something more akin to what we have seen in the past, where tariffs were a negotiating tool and used to renegotiate trade deals. We had the USMCA signed in the first Trump administration. He said it was the best, went from the worst trade deal to the best trade deal ever made. But again, I mean, we'll just have to continue to watch. But I would say that if there are tariffs on USMCA partners, there will be a negative impact on the American economy. The supply chains obviously are highly integrated, especially in the auto sector, but even more locally in Maine's economy. Half of the imports and exports are with Canada. The lobster industry is highly integrated, as I'm sure you know, but especially given seasonality, half the year lobster are coming from Canada, the other half they're going the other way into Canada. A lot of them lobster are processed in Canada and brought back to Maine. It takes time to change that, given decades of economic integration. But again, if North American trading partners, if this ends up, an extension continues, and there is an intense lobbying effort from a lot of American companies to not put those tariffs on the USMCA partners, then the impact, I think, will be pretty minimal. Obviously greater if that takes place. Immigration, what we've built into our baseline is pretty limited, just a kind of a return to what we had in terms of the level of deportations, higher than what they were under the first Trump administration, getting to the highs of the last several decades. But again, that isn't so much of a game changer. But again, if it is, there are 8 million or so unauthorized workers, people participating in the labor market, and if they were all to be deported in short order, it would reduce the size of the labor force in a way that would put upward pressure on wages. It's that's 8%, or 8 million out of 150 million. It gets to be close to a 6-7% shock to the job market. It is bigger in certain sectors, agriculture. And especially in the American South, and where there is a lot of fruit picking, where they're actually highly dependent, almost entirely dependent on unauthorized migrants, and those industries would be certainly disrupted. On the other side, the Trump agenda had a lot of promises of tax cuts. Certainly extending the Tax Cuts and Jobs Act. We did have Congress, at least the House, pass a budget bill, so we won't have a shutdown mid-month, and they passed it with the goal of extending those tax cuts and finding offsetting cuts elsewhere to offset them. We'll see what happens with reconciliation with the Senate, but certainly some of those items would be growth enhancing. And that kind of brings us to where our overall forecast lays if we don't get sort of a massive increase in tariffs. Now, we did include some. We have to, because we said it would happen. We've already seen 10% tariffs on the Chinese economy that went into place at the beginning of the month, and And of course, the rest of the world as well. We did think that there would probably be some tariffs imposed on Europe. We've not built in 25% tariffs, which was what the most recent talk is. And we had not built in 25% tariffs on Canada and Mexico into our baseline outlook. So I think just a little bit of context on the situation in North America. There, the executive order, as mentioned illegal migration and drugs coming over the border. There certainly the border encounters. I mean, you saw that. I have another chart on maybe it's further on. Pardon me, on migration. But obviously there was an increase in the number of entrants in the southern border. Very few are coming from the northern land border, although that has increased relative to where it was in 2022. It's really slowed. The year has just started, though. And then, of course, the trade deficit is the other concern. Mexico has the United States and Mexico the second biggest trade deficit of any country that the U.S. has. I mean, that speaks to the scale of trade in both directions, but the trade deficit is the second largest after China. The United States does have a small trade deficit with Canada. It is entirely in energy. It is in imports of raw crude that is brought to the U.S. and is refined in American refineries. If you take energy out, then the United States has a trade surplus with Canada, actually quite a large trade surplus in services, especially digital services. What can happen in terms of concessions? There is the renegotiation of the USMCA, or at least every country has to sign on again in 2026, and some of this may be to put leverage on Canada and Mexico as that deal is renegotiated. Some of the irritants that have been talked about, I mean, access to dairy in Canada is one thing that the president has talked about, and there are strict quotas on imports of dairy into Canada and as well into the U.S. from Canada. So there's very little trade in dairy over the two borders. That's been something that was protected even in the USMCA, but something that we've heard is a complaint. Mexico, there are irritants, especially around they restrict corn imports into the country. They produce a lot of it, and they use genetically altered. They're worried about the way that corn is grown in the United States, and they've put restrictions on that. That's a bit of an irritant. A long time irritants in terms of timber, especially from Canada, where the price of timber on Crown land is quite low, and much of Canada's timber comes from Crown land versus in the United States, where a lot of it is on private land. It costs more. There are already tariffs on Canadian lumber as a result of that, but if they were to increase, they would be on top of the existing tariffs. But the point is that trade with the United States is a much bigger share of the economy in Mexico and Canada than it is vice versa. So these countries have a lot more to lose than the United States does. That's something that the president constantly reminds people of. But it's roughly 1/5 of the Canadian economy exporting goods to the United States. It's 1/4 for the U.S. And if you look at it, the opposite, it's 4% or so exporting. I mean, things get higher when you add imports to exports. So for the Canadian economy, they would retaliate, is what they've said, Mexico as well, and that will raise the cost of imports to their country and worsen the economic impact there. But the reality is that there is some leverage there, just given the size and the importance of trade to the countries north and south of the border relative to the United States. Nonetheless, and you saw what we had tried to estimate in terms of the impact if there was a kind of worst-case tariff scenario. We had also embedded in that assumption that there would be extensive tariffs on China. Would seem a bit strange to put higher tariff rates on Canada and Mexico than on China. That's currently what it will look like if tariffs go in place at the beginning of March. But we'd assume that tariffs on China would be increased as well. The good news is the American economy will still grow. We likely still have positive growth, albeit at a much slower rate. And there may be some volatility in terms of quarterly growth rates. And at that kind of growth rate, hard to see the unemployment rate doing anything but moving higher. And of course, it will be inflationary. So if you raise the tariff rates, it can really be paid by importers, by the sellers in terms of profit margin, or they raise prices to consumers. And obviously depends on the availability of substitutes. There are some goods where there will be substitution. There are others where there just isn't enough production. Aluminum is one of them where there is very limited capacity to increase aluminum production in the United States. These are very long-lived investments, and they also depend on cheap electricity, which Quebec happens to have. So those are the areas where I would expect to see the highest increases in prices. The 25% tariff on Canada, I should mention, it was 10% tariff on Canadian energy, so a lower rate on energy, which would reduce the impact there. But in the short term, there is very limited alternatives, so there will be increased prices to consumers there. And we try to do this quantitatively, by looking at the share of the consumption basket. You have to look at historical data and try to find what the elasticity of demand is, how much imports would decrease, but also what the incidence of the tariff will be. And in our estimation, you would see an increase in inflation over the 4% mark would we see these tariffs go in place. So, you see the rate start to slow through the year after that as there is an economic impact that reduces the inflationary impact. But in the near term, it would put upward pressure on prices. We'd call that a mild stagflationary shock. The other issue, as mentioned, obviously, is the immigration. We did see a real surge in immigration, most of it unauthorized, prior to between 2023 and 2024. We have seen that slow already quite dramatically. And again, our baseline forecast kind of goes back to the the norms that we saw in the decade prior to the pandemic. If you were to see obviously much stronger action there, then there would be even slower labor force growth. And as you can see, I mean, most of the increase in population is dependent on immigration. Some of the reason that we've had the job growth that we've had over the past few years is related to the rate of immigration. Inflation, as mentioned, I mean, that you saw kind of the expectation with and without tariffs. The inflation rate has certainly improved from the post-pandemic environment. In January, though, the CPI inflation rate accelerated from 2.9% to 3%, so it's not quite normal. The Fed targets a 2% inflation rate roughly, and it's at about 3%. We've certainly seen improvement in goods, but goods are traded. So if you were to see tariffs, then goods prices are going up. Non-housing services, those are that's actually the core of the basket, of the consumption basket, and those have seen prices slow, but kind of not, the improvement has really ceased over the last year or so. And shelter prices have been coming down. I mean, that is something we have been expecting. Owner's equivalent rent is based on basically the rental market, and we have seen that rental demand has slowed, and market rents have actually come down faster than what's in the CPI basket, and that should continue. The labor market has also really come back into balance from being very, very hot in the aftermath of the pandemic. There's a lot of lines here. The reason that we kind of put this together is that one indicator might not tell you everything you need to know. Hopefully, if you use a bunch of them and they're all telling the same story, it kind of gives you a picture of the underlying strength in the labor market. But if you're above the axis here, that is a very hot labor market, and when you drift below, that is a more balanced or looser labor market. And certainly at the peak of it, there were 2 job openings for every unemployed every unemployed person, that was a very tight labor market. And we have seen a bit of a rise in the unemployment rate, came up from a low of 3.5%, was 4% in January at a national basis. So we have seen, and as a source of inflationary pressure, I think the Fed has achieved a pretty soft landing in the labor market that we've seen. Should have skipped. I want to do that. Oh, geez. My ordering is not what I would have liked. But the direct connection there is sort of wage growth, and wage growth has also slowed to about a range consistent with the rate of labor productivity, which would suggest that shouldn't be putting upward pressure on inflation or lead to any kind of wage price spiral. The good news is that income growth has continued to be strong even as wage growth has slowed. So I'll go back quickly just to kind of finish this thought. Even as we've seen sort of a balanced labor market, the rate of job growth has continued to be pretty good. I think this is an indicator worth watching. It is difficult, though, to gauge sort of what the break-even level of job growth should be, especially as you have these moving parts in terms of immigration and changes in labor force participation. But anything over 100,000 in a normal environment is pretty solid job growth. And we've been, you had a slowdown there toward in October, but definitely gangbusters in November and December, and we continue to see well above 100,000 in January. So the labor market's doing quite good in terms of the number of jobs generated. And the unemployment rate, as mentioned, it has come off its lows. In Maine, we've seen the unemployment rate at its low in the pandemic when it was, the labor market was in the mid-2s, and we're now at 3%, which is still pretty close to where it was prior to the pandemic and still maintaining a gap, not only with the U.S. but with the rest of New England. Okay, so what does that all mean? Trying to piece it all together, obviously for the real estate market, and from my point of view, the important point is interest rates. The mortgage rates have been high. We've seen still close to 7%. 7% rates would be a lot. It would be helpful if we could see rates start to come down. If our baseline forecast plays out and we don't see a trade war, I think that the Fed will continue to cut interest rates. We will get 50 more basis points in cuts before the end of this year, and that should show up in terms of lower mortgage rates, lower longer-term government bond rates, and lower mortgage rates. Our expectation is, again, under a lot of assumptions, that we see the 30-year mortgage rate come down about a percentage point over the next year. That reflects both the spread over the 10-year Treasury falling a little bit and the Treasury rate, which is currently 4.2%, the 10-year Treasury rate. We think we could get to about a 4% rate over the next year as the Fed continues to cut. That said, there are other risks to that as well. The major one is we had seen in the lead up to the election increasing term premium, which is just to say the increase over and above inflation expectations, which have also been ticking higher, but that seem to move higher, and that there is a close relationship between sort of borrowing costs over the long term and the size of the deficit. It makes sense. That's sort of supply and demand for treasuries. The fiscal situation is still one in which, going into the next year, there is a 6% of GDP federal budget deficit. The current bill that the House passed, I don't know if bill's quite the right word, but would try to extend the Tax Cuts and Jobs Act, which would increase these deficits relative to this baseline. So, that's going to require more action than even just what's there in terms of some of the budget cuts that they hope to put in place to fund those tax cuts. So, just watch it. You have seen yields start to come down, by the way. They have come down, unfortunately, I think, a bit on some of the growth concerns that I've been talking about and the tariff risks, not necessarily because of, inflation really coming down. But if we are to see that play out, that would be good news. The issue in housing really now is affordability. And you've seen that even as, rates have remained quite high. I mean, as we heard Beth and we heard earlier, supply is really the issue. We need to increase the amount of housing supply. That is true at the state level. That is true at a national level. But prices have grown faster than the national level in Maine, and especially here in the more urban areas of the state. And that's good news for homeowners, but it's perhaps a challenge in terms of affordability for new people entering the housing market. Affordability is pretty close to historic lows given the interest rate environment and the rate of home price growth relative to income growth. So again, the good news, and I'll kind of close just on some thoughts on Maine. I hope I've kind of given the overall national picture, and happy to take. Well, I only have 3 seconds left, so maybe I can't take questions. But good news is Maine is continuing to draw people into the state. Obviously, need to build the houses for them. But this is obviously good news because this is going to be what is required to continue. It's not so. There's no demand issue here. There's supply issues in terms of the number of people and the sort of productive capacity of the state, especially given, as you know, the demographics. Even with that return there in terms of if you average that over the past 5 years, what I'm showing here is the average growth by age cohort from over the past 5 years to 2023. That's the last data point we have. Even with that return in immigration, you still have that almost all of the population growth has been over 65. So that's still going to be a challenge, even if you continue to have strong net migration. And that's it. I hope I didn't sound like too much of a dismal scientist, but hey, here we are. Thank you.